Hello guys and welcome back to my channel. This is Random Guy on YouTube. The next stock is Chinese microcap company which I bought 3 weeks ago, LIZI Incorporated. LIZI was founded in 2010 and went public on Nasdaq in January 2020. The company's mission is to enable everyone to showcase their vocal talent and enjoy immersive audio experiencing. LIZI's platform offers a variety of content genres such as music, talk shows, podcasts, audiobooks, and more. Users can create, share, discover, and interact with each other through voice-based content. The company also has a strong technology advantage with its proprietary AI-powered audio technologies such as voice conversion, voice beautification, and voice cloning. LIZI also leverages blockchain technology to protect the intellectual property rights of its content creators. LIZI generates revenue mainly from virtual gifts, premium subscriptions, and advertising. In the first quarter of 2023, the company reported revenue of 631 million RMB, up 22% year-over-year. Non-GAAP net income attributable to LIZI Incorporated's ordinary shareholders was 59.5 million RMB in the first quarter of 2023, compared to 25.2 million in the first quarter of 2022, representing a 136% increase. LIZI has a low valuation compared to its peers in the online audio industry. The company has a market cap of $42.5 million and a price-to-earnings ratio of 2.7. The company also has a net cash position of $54.5 million or $1 per share, which means that the market is valuing its business at less than $0. So why is LIZI so undervalued? Well, there are some risks and challenges that company faces, such as the intense competition in the online audio market in China, where LIZI competes with giants like Tencent Music, Scout Music, Himalaya FM, and others. The regulatory uncertainty in China, where the government has been cracking down on internet companies for various reasons, such as antitrust violations, data security issues, and content censorship. And the low monetization rate of its user base, as most of its revenue comes from virtual gifts from small percentage of paying users, and stagnating user base. However, I believe that LIZI also has some opportunities and strengths that can help it overcome these challenges and grow its business in the long term, such as the increased demand for online audio content in China, the diversified and differentiated content offerings of LIZI's platform, which cater to various user interests and preferences across different age groups and regions. The innovative and interactive features of LIZI's platform, which enhance the user engagement and retention rates. I think that LIZI deserves more attention from investors. The company has a lot of potential to grow its revenue and profitability in the future and create value for its shareholders. I added this stock to my portfolio on the 23rd of July at the price of 79 cents per share. The current price is 81 cents, so I am only 3% up on that position and the company remains to be an interesting opportunity. Let's go to the next one. Tingo Group is a global fintech and agri-fintech group of companies with operations in Africa, Southeast Asia, and the Middle East. Tingo Group's wholly owned subsidiary, Tingo Mobile, is the leading agri-fintech company operating in Africa with a comprehensive portfolio of innovative products, including a device-as-a-service smartphone and preloaded platform product. What does that mean? Well, basically Tingo Mobile provides farmers with affordable smartphones that come with a platform that connects them to various services such as the Nwassa seed-to-sale marketplace platform, insurance, microfinance, and mobile phone and data top-up. This way, farmers can access information, markets, and financial services that can help them improve their productivity and income. Tingo Mobile has over 9.3 million subscribed farmers in Africa as of 2022, and it has recently entered into trade partnerships that are concentrated to increase that number to more than 32 million. That's a huge potential market for Tingo Mobile, and it shows how much demand there is for its products and services. But Tingo Group is not just Tingo Mobile. It also has other business verticals such as Tingo Pay, a super app in partnership with Visa that offers a wide range of B2C and B2B services, including payment services, an e-wallet, foreign exchange, and merchant services. Tingo Foods, a food processing business that processes raw foods into finished products such as rice, pasta, and noodles. And Tingo DMCC, a commodity trading platform and agricultural commodities export business based out of Dubai Multi-Commodities Center. In addition to its Tingo business verticals, Tingo Group also holds and operates an insurance brokerage platform business in China. And Magpie Securities, a regulated finance services fintech business operating out of Hong Kong and Singapore. As you can see, Tingo Group is a diversified and global company that operates in high-growth sectors and regions. The recent revenue growth was fueled by a merger with Tingo Mobile in November 2022. With the net income of 177 million in the first quarter of 2023 and number of diluted shares of 524 million, we get 0.33 earnings per share, which would be $1.35 annualized. That would make the company incredibly cheap with the PE of merely 1.1. The company balance sheet has a huge amount of debt, but it has also more than enough cash on hand to cover the debt. It looks like an incredible value to me. It almost seems to be too good to be true, so I'm unsure if I'm not missing something important. You should do your own research before investing in this company. I bought Tingo on the 14th of July at the price of $39. Current price is $1.44, and so far I am up 3.6%. My next stock is the smallest company so far, having only $20 million of market cap, which puts it firmly in the microcap category. BOXL Corporation is a company that develops, sells, and services interactive classroom technology products and solutions for the K-12 education market worldwide. The company sells its integrated solution suite, including interactive displays, collaboration software, supporting accessories, and professional services. BOXL also distributes science, technology, engineering, and math products, including its 3D printing and robotics solutions and its portable science lab. BOXL Corporation has a strong focus on innovation and research and development. The company aims to improve communication and engagement in diverse business and education environments by developing the solutions its customers need. BOXL backs up this ability with trusted relationships, knowledgeable and dedicated employees, and unsurpassed customer service, and the most comprehensive selection of quality interactive solutions. BOXL has a strong history of revenue growth, increasing 53% annually in the last 5 years. However, the last quarter was unfortunately weaker, with the company making only 41 million in revenue, 19% down from the first quarter of 2022. Despite a challenging first quarter with softer customer demand across the industry, BOXL significantly improved margins. The company remains unprofitable, however analysts are expecting positive earnings of 35 cents per share next year, which would put BOXL's forward PE at 6.6. So it appears like the company is making a significant progress towards profitability in difficult macroeconomic conditions. Despite that, the share price is close to all-time low. With the micro market cap, no profitability, history of share dilution, and the share price falling for years, this is definitely extremely risky investment, not suitable for majority of investors. I added this stock to my portfolio on the 7th of July at the price of $2.32 per share. Current price is $2.28, so I am down roughly 2% on this investment so far. My next stock pick is a television broadcasting company, Gray Television. Gray Television is one of the largest and most diversified television broadcasters in the country, with 113 stations in 101 markets, reaching approximately 24% of US television households. Gray Television offers local news, weather, sports, entertainment, and other programming to its viewers, as well as digital platforms such as websites, apps, podcasts, and streaming services. Gray Television has been growing its revenue and earnings steadily over the past 2 years, thanks to its strategic acquisitions of other broadcasters, its strong performance in political advertising, and its diversified revenue streams from retransmission fees, digital media, and production services. In 2022, Gray Television reported a record revenue of $3.68 billion, an increase of 52% from 2021, and net income of $403 million, an increase of 961% from 2021. Gray Television also pays a quarterly dividend of 8 cents per share, which translates to a yield of 3.56%. Despite these impressive results, Gray Television is trading at very low valuation, with price-to-earnings ratio of 3.15 and forward PE of 2.3. So why is Gray Television so cheap? The main problem is its absolutely massive debt of more than $6 billion, and if the earnings were to deteriorate, this could spell a huge problem for the company. The second problem may be that Gray Television operates in a highly competitive and regulated industry that faces challenges from cord-cutting, streaming services, and changing customer preferences. Traditional media is being overtaken by independent creators on the internet. These are significant risks, but I am willing to take them. On the 30th of June, I've added GTN shares to my portfolio at the price of $7.88. Since then, the stock price rallied because of better than expected Q2 revenue. Current price is $10.50 and I'm up 33%. However, because of the very low valuation of GTN, you may still be interested in doing the research and considering it for your own portfolio as well. Okay, it is just 2 stocks left to catch up on the last 2 months of my investing. My next stock is Hudson Technologies. Hudson Technologies is a refrigerant services company that provides solutions to recurring problems within the refrigeration industry. The company's products and services include refrigerant and industrial gas sales, refrigerant management services, refrigerant site services, and smart energy services. The company serves commercial, industrial, and governmental customers in various sectors such as food processing, supermarkets, hospitals, chemical plants, and power generation. Hudson Technologies has been growing rapidly in the past few years thanks to its innovative and sustainable solutions that help customers reduce their energy costs, improve their environmental performance, and comply with regulatory requirements. In 2022, the company reported a revenue of $325 million, an increase of 69% compared to the previous year. The company also reported a net income of $104 million, an increase of over 200%. The company expects to reach sales greater than $400 million in 2025. The company's earnings per share in the last 12 months was $1.46, which translates into price-to-earnings ratio of near 7. One of the reasons why Hudson Technologies is doing so well is its Emerald Refrigerants product line, which is a collection of reclaimed refrigerants that are certified by the Environmental Protection Agency as acceptable substitutes for ozone-depleting substances. Emerald refrigerants are environmentally friendly, cost-effective, and compatible with existing equipment. The product line was named as one of the top products of 2023 by Environment Plus Energy Leader. Another reason why Hudson Technologies is a promising investment is its strong competitive advantage in the refrigerant reclamation market. The company has the largest reclamation capacity in the industry. I believe that Hudson Technologies is a great company to invest in, as it offers a combination of value and growth potential with a healthy balance sheet. I added shares of Hudson into my portfolio on the 23rd of June at the share price of $9.20. Current price is $10.55, which is 15% higher than my buying price. However, I don't think about selling yet, since Hudson has good growth prospects and at PE of 7 is still rather undervalued. The last company that I will present today is Revolve. This is probably the best known company from the bunch since it is one of the Jeremy's stocks. I feel dirty just saying that I picked the same stock as him, but this one might be actually a good pick right now. Revolve Group is an online fashion retailer for millennials and Generation Z customers. It operates 2 segments. Revolve is the main platform and offers apparel, footwear, accessories, beauty and home products from over 500 emerging, established and owned brands. Forward is a luxury e-commerce site that sells high-end designer clothing and accessories. The company also operates a network of global fashion influencers who promote its products on social media and generate organic traffic to its websites and apps. Revolve Group has a unique business model that leverages data analytics technology and social media to create personalized and engaging shopping experience for its customers. The company uses data to track customer preferences, trends, inventory levels, pricing, and marketing effectiveness. It also uses technology to optimize its supply chain, logistics, fulfillment, and customer service. Moreover, the company uses social media to create loyal community of customers and influencers who share their style, inspirations, feedback, and reviews on its products. In the last 5 years, the company grew its revenue by 22% CAGR. RVLV is profitable, but the current PE ratio of 31.6 seems to be quite high. The company proved that it can generate much higher earnings, but right now we might be in a cyclical downturn and the margins are much lower than they used to be. I am of the opinion that the margins can recover over time, in which case RVLV would look much cheaper. The stock price has fallen by 77% since the top in 2021, and I think the company is undervalued. On the 16th of June, I bought shares of RVLV at the price of $16.23. Since then, the stock went up and then down again, and right now it is sitting at $17.57, just 8% up from my buying price, and this might be another buying opportunity. These are the stocks I bought in the last 2 months, and now let's just quickly go through the portfolio update. My portfolio is outperforming Nasdaq again, and I didn't have to buy any of the overpriced AI stocks to achieve that. Currently, I am up $429 on a $3,200 investment. The invested money was distributed evenly over the time. That gain translates into portfolio return of 26.8% compared to Nasdaq's 26.6%, S&P's return of 16.4%, and Russell's return of 13.6% since the beginning of the year. All these numbers assume buying into the fund is $100 each week. Please understand that I am just a random guy on YouTube and not a financial advisor. Do your own research when buying stocks. I cannot be liable for your investing decisions. This is all from me today. Thank you for watching and see you next time.